Hello and welcome to the Market Talk, LiveSquawk's preview show. We delve into uh, data and key central bank events across the trading month to bring you just the key points and to try and break down what the data and the policy decision means. Today, I'm joined by two eminent guests we've had on before. Joseph Choi, author of The Curve Advisor, and Gunter Grimm, portfolio manager, who speaks in his own capacity, and will take you through not only the FOMC rate decision, but also the Bank of England, which is out tomorrow, and the Swiss National Bank, the SNB, also out tomorrow as well. Before we go any further, though, and before I introduce my two guests, just a disclaimer here. The content rather provided on this channel is for informational and educational purposes only. I'm not a licensed financial advisor, and none of the information shared should be considered as financial, investment, or trading advice. Please conduct your own research, consider your financial objectives, and consult a qualified financial professional before making any investment decisions. Investing and trading in financial markets carry risks, and past performance is not indicative of future results. Neither I nor my guests are responsible for any losses or gains that may result from following the content on this channel. And with that, I'd like to bring in my two guests. Hello, Joe.
Oh, hi there.
How you doing,
Thanks for
Joseph?
having me on.
Always a pleasure. And Gunter, how are you?
Hello, thank you very much, and thanks for having me on as well.
Brilliant, thank you. I think with you two and your big brains, we should sort this out straight away. So before we get into the reads, let me just go over what we are looking at for today. And it's again uh, the primary feature for today, the focus is the FOMC rate decision. We're looking for rates to remain unchanged today at 4.5%. We're in the range really, 4.25%, 4.5%. Fed funds target range. TD Securities here with their note. They say forward guidance is likely to see is unlikely to see major changes given the uncertainty looming over the economic outlook. We also do not expect policymakers to tweak the quantitative tightening plans for now. In that sense, the Fed's summary of economic projections, or the SEP, might get most of the attention on Wednesday. However, we also fear market participants might find themselves disappointed there as well, as the Fed officials aren't likely to make wholesale changes to their economic views just yet. I've written a preview out there as well for anyone who wants to have a read. Headlines on this one: trade tensions, weaker growth to weigh on forecasts, projections to show fewer cuts and higher inflation, with Powell expected to avoid any controversy. And by that, I mean by wading into the current tariff issues that the US is facing, or battles the US is facing with its near neighbors and beyond, and also just some of the market turbulence we're seeing as well. Right, I'd like to bring in, I think, Gunter, we'll go with you first on this. What are your initial views on today's interest rate decision?
Yeah, thank you. Yeah, as you rightly said, the Fed is in a difficult corner, I would say. I
Gunter, we
don't
can't hear
envy
you
them.
right now.
Can you hear me? Hello? Hello,
Let's see
can
if
you
we
hear
can
me?
go in. All right, while we get Gunter fixed in here, Joe, we'll start with you. What are your initial views on today's rate decision?
Oh, well, so no one's expecting a change to the rates, and as for the SEP, everyone's
Right,
expecting
hello, we
GDP.
can't hear me now.
Hello, hello.
Hi there,
Hopefully you
can
guys
you
can
hear
hear
me?
me.
Oh, hey Harry.
Harry?
Hey Gunter, can you hear me?
I can hear you. Can you hear me?
Yes.
It's okay.
So I think Harry, there's something wrong with Harry's headphones.
Okay, we have some technical issues on this end, and I can't hear even my guests. Bear with me 1 second. all going so swimmingly well. Apparently, I'm the one with the problem.
Shall we carry on, maybe, Joe?
Sure. Why don't you start?
Okay. Let me share my screen. Okay, so hopefully, I think Harry has to share the screen. Anyway, I keep rambling. So as Harry said, the Fed faces a difficult decision. They're facing higher inflation due to tariffs. At the same time, I believe the economy is slowing, and the market is expecting them to raise the dots a bit. That would come across a bit hawkish. However, I would fade that move. So initial hawkish response, you could see the dollar rallying. You could see that bond yields might increase, stocks come under pressure a bit. But I think the end game is, in my view, that you will see this inflation bump. The economy is slowing. The inflation will more uncertainty going forward with the tariffs. 2nd of April is an important day for your risk calendars, and that could lead to some turbulence, and it could lead to further deterioration in the outlook, which I think will then prevail and dampen also inflation further down the road. And you can see that in the inflation swap curve. There's a bump at the shorter end, 1 or 2 year maturities are showing higher inflation expectations, and then it converges back down towards the Fed's inflation target. And that is also my scenario from here. Fiscal policy is also a bit austere, so less spending there. So all in all, I think further down the road, the Fed will ease, probably more than expected, and that should lead to dollar weakness. Joe?
Okay. So I guess my take on the Fed meeting today is that in the SEP, everyone's expecting GDP to get revised down just because growth has been weaker, especially the Atlanta Fed GDP now, which is showing a negative number, and that inflation will be revised higher, and the unemployment rate will be revised higher as well. I mean, these are all commensurate with the recent changes in the data we have gotten so far this year. What I'm most interested in are the dots. There are a few interesting dynamics going on. In December, FOMC members had to guess what Trump's policies were going to be, so only about half the members incorporated Trump's policies in their projections. Now people should have a better idea of what Trump plans to do, so more of the members will incorporate Trump policy in their dots. The markets have concluded that Trump's policies in the near term will provide upside risks to inflation and downside risks to growth. We'll get a somewhat clear read on whether the Fed's going to care more about inflation or growth. This is because no one thinks there are downside risks to inflation in the short term, since every major inflation indicator has shown upside risks. For example, the next core PCE is supposed to be between 0.3 and 0.4. ISM price indices are higher. The U-Michigan inflation expectations are higher. And then similarly, no one thinks there are upside risks to growth in the short term. So the data has held up reasonably well so far, like payrolls and retail sales. But everyone's expecting a fallout from Doge layoffs, lower consumer sentiment, lower equities, and maybe even immigration policies. So any noticeable surprise from the consensus expectations in the dots may show what the Fed fears more, inflation or a slowdown. So I think people are expecting the 2025 dot to be fractionally higher. If this is lower, it may be a concern about growth. And dots than expected would signal more concern about inflation and inflation expectations. It'll be interesting to see if anyone suggests there may be a hike, but this is not my central scenario. I would think the risk to the spread between 2025 and 2026 dots may price in more than the two eases shown last time. Although, according to Bloomberg, they're only pricing in 1.5 eases for 2026. And then I'll also be looking at the longer run neutral rate. It seems to rise every meeting, but the longer end has stabilized since the yield highs in January. So I'm wondering what the members will put down as their dots. And then in terms of press conference tone, the Fed's going to be non-committal since there's a lot of information pending, especially what happens after April 2nd with the tariffs. So Powell is probably going to say the policy is in a good place, like he always does. And Powell may discuss to what extent the Fed may have priced in more of Trump's policies. The thing I'm most interested in is his thoughts on inflation expectations. I would think that he would still say they are contained. I mean, even if he has to lie, I don't think he can really come out and say they're not contained. But the U-Michigan data has to be unnerving. However, the market inflation indicators and New York Fed inflation expectations seem to be calmer. So I'm not sure what Powell's take on inflation expectations are going to be. And implications, they're currently 57 or so bips priced in for this year and about 76 bips for the cycle. We bear flattened quite a bit the past week with the front end selling off 18 basis points since last week's inflation data. So the markets are not expecting the Fed to be dovish in the near term. On the one hand, there are only about 125 bips until the Fed gets to neutral, and probably less given that the neutral rate seems to go higher every meeting. However, given that the recession odds are probably 30 to 40%, and I've heard Jeffrey Gundlach mention a number as high as 60%, you have to think that a chunk of the modest number of eases priced in are just tail risks. Because in a recession, the Fed could easily ease way past the longer run neutral rate. So I guess I'm really looking forward to seeing what the market reaction is after the data. So Gunter, do you have any thoughts on the BOE or SNB rate decisions later in the week?
Yeah, let's focus on the SNB, given that I'm living here in Switzerland, and wait for Harry to comment on the Bank of England, although I have a view there as well. So, on Thursday, we have the SNB rate cut among economists is widely expected. Currently, the policy rate is at 0.5%, believe it or not. Market expects them to cut by 25 basis points, 2.25. The market, so the stir traders also price in a rate cut. So a rate cut is more or less, famous last words, priced in. And that's also my view. Why take the risk of not cutting? I would ask myself, because if they don't cut, you could see the Swiss franc strengthening quite a bit, especially versus the dollar, I think, given the euro outlook looks a bit more brighter, given what's going on with fiscal policy there. But dollar Swiss would then probably go down, especially after the Fed, maybe if they come across a bit dovish, then so there's no risk of not cutting, I would say. And the inflation outlook is very important to watch. In the press statement on page 2 of their monetary policy assessment, you always see the chart with their inflation forecasts. I wouldn't be surprised if it comes down a touch, especially at the long end. We already had an economic think tank here in Switzerland lowering their long-term inflation forecast. And these forecasts from think tanks in the S&B are very well correlated at times. So I would not be surprised if the S&B does the same. And that's also a strong signaling factor that they're ready to ease more. They could go to 0 in theory. They could even go negative. We should not forget that as well. There we are used to negative interest rates in Switzerland, although the SNB will probably try to avoid it as long as possible if they can. Yeah, so I would expect the cut medium term, especially versus the euro. I'm negative on the Swiss franc, but that's another discussion that comes more from the euro side, given what's going on with fiscal policy. I think we touched on that briefly last time when we had the ECB preview. And this scenario has come out now. So I would expect the rate differential between the Eurozone and Switzerland to widen in favor of the euro. So Euro Swiss is my favorite pick at the moment, higher. Thank you.
Oh, so I don't follow the
Right,
European
let's see if you can
markets
hear me
as
now. Can you hear
closely.
me at all?
Yes.
Yes.
I can hear you guys, but well, I can't hear you guys, but you can hear me.
Okay, then we continue, Joe. Do you have a view on the Bank of England?
Oh, yeah. So I guess what I wanted to point out is that, in my opinion, those two countries show an interesting range of possible tariff outcomes because Trump appears to be basing the magnitude of tariffs based on the size of the trade deficit with the U.S. So the U.S. has no trade deficit with the U.K., so any tariffs will be minimal. So Trump actually implied as much when he met with Starmer last week. The Swiss, on the other hand, have a fairly large trade surplus with the U.S., so they may take a large economic hit from what I expect will be large tariffs coming their way, and so they're in the same boat as as with most of the rest of the EU. And I think the degree to which these two respective economies will be hit by tariffs are somewhat reflected in the ease pricing in the near term. So I just found that somewhat interesting, but I don't really have any, other specific commentary with respect to those two countries.
I agree with you, Joe, and I think that's also a reason why they should cut as a precautionary measure. The thing I'm wondering is why is the SMI, that's the Swiss stock market, at close to historical highs despite the threat of tariffs? And my explanation is that given what's going on in the Eurozone with regard to fiscal policy, that there are also some positive spillovers into Switzerland for Swiss companies who will also benefit from this fiscal largesse we are witnessing. I really compare it, it's a similar period to the German unification period where we also had huge fiscal stimulus, and this could happen again. I think it's once in a lifetime event what we're witnessing here. So I can't emphasize it enough for our listeners.
Yes, I agree. I think everyone is just so used to European growth being in the doldrums that there can be a lot of interesting things that happen with the European curves as well as the economies.
And regarding fiscal policy, that brings me to the UK. And I don't have a super strong view on the Bank of England, but I think the risk is that at some stage they will also have to cut more than the market is currently expecting. And my main argument would be fiscal policy, actually. So we had a period where they raised taxes to pay for their rather expensive spending plans. We are beyond this period now. Now they're facing a day of reckoning. They can't tax more. They can't issue more debt, or they're fearing that the bond market will punish them should they issue more debt. So they have to save now. And you saw Starmer and the Chancellor also thinking about cutting benefits, which for a Labour Party is really something. So you see that the urgency there. So you will probably see some fiscal austerity that should, in theory, dampen growth, make the Bank of England's job much easier going forward. And therefore, I think they could surprise to the downside. and that should hurt sterling. So I'm also watching closely euro sterling here for upside going forward.
Thank you for that, guys. Can you hear me? Is that better?
Yeah, we can hear you.
Oh,
Yeah.
thank God for that. You two, I love you two. You're my saviors. I've had
Don't worry.
issues with my microphone non-stop throughout all this whole thing, but I have been listening and paying attention to what you guys have said. Thank you for the Bank of England output as well. I wanted to just quickly circle back on the FOMC, just very quickly. Do you think, and this I'll put this to Joe first, do you think the Fed needs more hard evidence in terms of the growth outlook before they really take any pay any attention to it? I mean, we know the inflation is a little bit on the frothy side, a bit perky at the moment, but they can see through that, I guess. But is this about the growth aspect and what they deem to be a slowing economy? Does, either of you got any sort of insight into that, Joe?
So I think the key is what they think about inflation expectations, because in most of the previous speeches by Powell and some of the other Fed members, they've implied that um, they're okay with looking at tariffs as a one-time level shift in prices. But
Okay.
the clause they always put at the end is as long as inflation expectations remain anchored. And so it's not clear to what extent inflation expectations are starting to become unanchored.
Mm,
Because if you look at the sentiment surveys, basically what's going on is most of the Republicans think everything is fine, while most of the Democrats have a severe scenario in mind where they think inflation, maybe 5, 10 or more percent from these tariffs. And so, so Democrats make up roughly half the population. So,
okay.
it's not really clear that you can say inflation expectations are anchored, but I'd be very curious to see how the Fed is going to spin, this situation.
I mean, isn't it more that people know whether inflation's anchored, or I mean, I know it's about expectations, but because they see it in their pockets. The last inflation readings that we got, food prices were still looking very hot at the moment, although there are other aspects that had counterbalanced that as well. But just in terms of people's pockets, things don't seem cheaper either side of the Atlantic to me. And personally, I just think we have this divergence between falling economic activity, and still spiraling sort of prices, and with that wages, because wages have still held up as well. Gunther, do you have any views on this hard growth? Just hard data, growth data.
Yeah, just quickly on inflation. I'm probably more in the positive camp, looking at market-based inflation expectations. So these inflation swap curves, which you probably, hopefully see on the screen, they
Yeah, I
show
can
the
see it.
bump, but then they come close to 3%. These are based on CPI, so you have to subtract the difference between CPI and PCE, which is the Fed's preferred measure. So we are
Right.
on target in the long term. And listen to Besant. Besant wants oil prices lower. Trump wants them lower as well. And why? Because they are the engine for the economy. And if oil prices fall, there's less inflation pressure in the economy. So, and oil prices have been falling. Maybe they fall more. I don't know. But that would help the Fed as well. With regard to the economy, I'm a bit more in the negative camp when it comes to growth, but you could see an interesting phenomena where growth slows, but the unemployment rate doesn't rise as much as you would have expected.
Right.
And why? Because labor supply is maybe falling because there's no more immigration into the US, and rather maybe the opposite, if these deportations come to fruition, or if employers get rid of illegal employees. So you could see a stable or slightly higher unemployment rate, which would give the Fed comfort, but the economy is slowing down, which is dangerous for the Fed, right? If they misread this, then they are tighter for longer. Then you could end up in a recessionary scenario. So watch the yield curve, twos, tens. If that goes flatter, then there's a danger on the horizon.
Fair enough. Okay. I know I did catch some of what you guys were saying about the S&B and the Bank of England. Just a quick note on the Bank of England. I think we have to keep an eye on the voting pattern as well, because I think that matters more so. We had a testimony after the last rate decision. I think it was an NPR. That's a monetary policy report as well. And we saw the likes of Mann just say, look, she voted for a deeper cut because she wanted less. I think, if I'm paraphrasing correctly, she wanted to less action and more impact on what that action was. So I guess it's one of those things we're going to have to watch in terms of the Bank of England. Obviously, we have the just some housekeeping. We have at the end of this month the spring budget, which will be interesting to see. Rachel Reeves, the Chancellor of the Exchequer, what we call a finance minister, will reveal the budget, and we're expecting more spending cuts to come. As well, or more cuts to government as well. So this Labour government, which people lauded when they came in, thinking that, look, they're here to sort of help the people, well, currently they're looking to be a little bit more stringent with spending than maybe everyone first thought. So it's going to be interesting to see the impacts that has on growth and the taxation element of all this as well, because it's you got the one hand they want to up their defence spending, on the other hand they're trying to cut other areas of government as well. So it's going to be one of those things. I think the Bank of England has to pick a very narrow path through that at the moment. So to watch that, and you said on the S&B. This is the last one. Was that the general view from you, Gunther, that this is the last?
Yes, depending on the currency, if for whatever reason risk aversion so strengthened too much, I think they could go to zero or even negative. But that would need really a big exogenous shock.
Okay, so there's that. Obviously, we had Bank of Japan overnight. I'm not expecting you to weigh in with that unless you have any particular thoughts on it. But we see BOJ keep rates unchanged today, as widely expected, really. And from the interpretation, they kept the door open. Really, I think most people now look for the next hike from the Bank of Japan around mid-year, June, July, is where the pricing is for that. So there's a lot of action with central banks this year. I mean, if you want volatility in the rate sector, you've got it at the moment. In most asset classes, I think it's there as well. Thank you, guys. We're coming to the end of our half hour. I do apologise for my. I don't know. I still don't know what happened. I'll find out what happened about my microphone. But thank you two for covering for me and for being so helpful with your comments as well. So thank you for that. As ever, we will bring you these podcasts whenever there's key data or central bank activity to preview. So listening for the next show. I'd like to thank my two guests, Gunter Grimm and Joseph Choi. Thank you guys for your input today.
Thanks for having us on.
Thank you very much. And we're about to get underway for the US cash markets, another roller coaster ride there as well. We'll edit this down and put this out again later today ahead of the FOMC for anyone who missed this live event. Thank you very much, guys, for listening, and see you again soon.
Thank you. Bye. Good luck, everyone.